Hello folks, welcome to the Wikipedia world and I am Abhinay Gupta. So by looking at the wallpaper behind, it is very obvious that we are going to discuss the Banking Regulation Act 1949. Remember the date 1949, 2 years after your independence. So as always, before starting the topic, I will discuss in brief what we have covered in our previous lectures. Right? So in our previous lectures, we have covered the history and the background of the Banking Regulation Act. We have covered certain definitions as per Section 5, the definitions of banking, banking company, loans divided into secured and unsecured loans, small-scale industry, substantial interest, etc. Right? Then we moved on to Section 7, where we had discussed the prohibition on the use of the word bank, banker, and the banking company. Right? And then we had discussed Section 9, which talks about the disposal of the non-banking assets in 7 plus 5 years, right? And followed by that, we had discussed Section 10A, which talked about the board of directors of the banking company. And it said that, more than 51% of the directors in your board should be person having specified knowledge, expertise, and practical experience. Right, they'll have to have specialized knowledge and practical experience on various topics. We had discussed it in detail, right? And then we had covered Section 12A that talked about the election of a new director. How is it to be conducted, right? And when will it be conducted? That's the 2-month period and stuff, if you remember. Then we had seen Section 17, the reserve fund, and Section 18, the cash reserve ratio. Right? Reserve fund should be minimum 20% of the profit before declaration of dividend, and in cash reserve ratio you had such percentage, right, as RBI would decide. Then we had seen Section 21, the powers of RBI. We had seen that the directions of RBI bound the banking company to follow it, right? And we had seen that RBI formulates the policy for advances, right? We had seen the various points in detail already. Then we moved on to Section 21A, where we learned that the court is not allowed to intervene. The court will not scrutinize the rate of interest that the bank is charging to its customers. Right? And then we moved on to Section 29, where we talked about the account and balance sheet for the first time. Right? We understood that it is prepared as per Schedule 3 and signed by whom and what. Right? Those things have been covered. So far in our 3 lectures before this, we have covered those various topics, right? Now today we move on to the next section, which is Section 30, the audit of accounts, right? So whenever this term audit comes to your ears, when they fall on your eardrums, there is an adrenaline rush. Auditors means us. We are CA final students. Some few months down the line, we are going to be the auditors, right? Definitely. I hope and pray that all of you convert into an auditor after your attempt. But is a chartered accountant the only auditor? The answer is no. For example, even in the case of the banking company, the Banking Regulation Act 1949 says that it should be conducted by any person who is duly qualified to be an auditor under any law for the time being in force. So it is not talking about the chartered accountant. It can be any person who has taken any degree that qualifies him to become an auditor. There he can be an auditor for the banking company as well, right? But no matter which law allows him to be an auditor, no matter wherever he gets his qualification from, but the Section 143 of the Companies Act 2013 remains applicable on the auditor as well. So what is Section 143? Section 143 talks about your duties, the powers, functions of the auditor. Section 143 of the Companies Act 2013, right? So that section is completely applicable on any auditor auditing the banking company, right? Now you all must be working with one or the other CA or any firm, I hope. Right, so you must have seen how clients are cracked. How do you get the audits? How do the client appoint you as an auditor, right? But in the case of a banking company, the procedure changes slightly. Now, what is that? The Act, the Banking Regulation Act 1949 says, Section 30 specifically, it says that the auditor who has to be appointed or reappointed or removed, whatever you want to do in the company, you will have to take a prior approval of the Reserve Bank of India. So without the knowledge and without the approval of the Reserve Bank of India, the bank cannot work. It has to work on the guidelines and policies formulated by RBI. Even if it is appointing its auditor, it has to consult RBI, it has to take approval, and whatever RBI directs, the bank has to follow. So ultimately, RBI is the supreme power who rules all the bank. So what basically happens is that when you approach RBI, right, for giving you the approval to appoint a director, RBI will do so when it receives the application, right? And there can also be circumstances where the RBI itself directs the bank to conduct an additional audit, right? And when RBI directs a bank to conduct an additional audit, RBI will also specify the transactions or the classes of transaction that will be covered in that audit, and also the period or various periods that will be covered, right? So these things are specified by the RBI. Now the question is, when does RBI ask the bank to get into a special audit, an additional audit, right? So whenever RBI deems fit or necessary in the interest of the public, depositor and the cooperative bank itself, that it is necessary to conduct an audit, right, to get a fair view of what is going on in the company, that is the time when RBI can order for an audit, right? So it is the discretion of the RBI. For proper governance, proper management, it can anytime go ahead and order an audit of the bank, right, specifying the transaction and the period to be covered under that audit. Now since, and over here again, the company will elect an auditor who can be anybody including a chartered accountant, any other auditor also, right? But this auditor who will be conducting the audit of the bank will submit its report to RBI back. Whatever report it generates, it has to give it back to the Reserve Bank of India, right? And also comply with all the directions that are given by the RBI. So we have discussed transactions and periods that are specified, and that audit is performed by CA and report is forwarded to RBI. It is not actually CA, it is any auditor, right? And then the expenses for this audit, like whatever remuneration you will pay to the auditor, whatever fees you pay to the auditor, sorry, or whatever other expenditures that you incur, will all be decided by RBI, but will be borne by the bank, right? Now when RBI has asked the bank to get an additional audit conducted, right, then there was a purpose behind it, in public interest, depositor's interest, and in the interest of the cooperative bank, whatever it be, but there was a purpose. So the bank needs to get an understanding and a fair view about what is going on in the company, right? So the auditor who is conducting the audit of the bank will have to make certain disclosures in its report before handing it over to the RBI, right? So whenever an auditor comes into the company and audits the books of account, right, it is very important that the account that the auditor receives is satisfactory, and the auditor knows that they are enough substantive quantitatively and qualitatively that the opinion of the auditor can be based on that information. So that is case specific and depends on auditors to auditors and company to company too, like its degree fluctuates. But at any point of time before giving his opinion, the auditor has a power and has also a duty to make a disclosure in the auditor's report whether or not the information that he has received is satisfactory. So if the information was satisfactory, we'll go ahead and rely on the report. But if information on the first one was not satisfactory, the report is of no value for me, right? Then second thing that the auditor has to check very precisely is that the transactions that the RBI has guided them to cover and for the period, so those transactions, whether or not those transactions are within the power of RBI has to be checked by the auditor, right? So if RBI has given a power to do A, the bank has gone ahead to do the transaction B, which is beyond the power. So that thing has to be reported in the books of account, in the auditor's report, right? Now, whenever you go for an audit, right, if that company has a branch, you as a statutory auditor of the company call for that report, right? And then because you don't want to visit the branch unless and until it is necessary, you get the report and base your opinion on that report, right? So once you have given out an opinion in the auditor's report, your report will be influenced by the return of the branch, right? So you will have to disclose in your report whether the branch's return was adequate, right? Whether it served your purpose, whether you have been able to constructively make a decision, right? To make an opinion. Then after that, they also have to disclose whether or not the profit and loss account gives out a true disclosure of the profit of the company for the period covered, right? For the period under audit. And then if there are any other matters that the auditor feels that yes it is important, right, then it will be brought forward. That will be jotted down in the auditor's report and showcased to the RBI. So the RBI gets the point and understand, right, what is to be improved or what action has to be taken or what is going on, what could go wrong. This is what the RBI can analyze, right? So those kind of information that will influence these decisions will also have to be included, right? So with that information, we'll conclude the chapter today, and we'll continue with the provisions of the other sections in the next lectures. So until then, stay tuned. This is Abhinay Gupta signing off. Thank you.